The market has seen such an incredible rise, and now we are in la la land. There's nothing stopping this market. Bad news ignored, economic meltdown ignored, systematic degradation of the financial system ignored. All that's important is the Fed. When you wake up in the morning, the Fed did that. Sun came up, the Fed did it. Food on your plate, of course, that's the Fed again. And they all lived happily ever after. The end. And now back to reality. You came here for the truth, so let me unveil that for you. Today we are going to look at the chart GPS. I've got so many here, it's going to make your head spin. I have probably 30 tabs open, and I want to cover everything related to the markets and what's been happening. I'm going to show you pieces of information that are coming from all corners. I'm going to give you the information you need to be able to determine what status the market is at today. You do what you want with the information. There are those out there who are constantly giving financial advice, and that works just so well during periods of time, and then things change. You have to be aware of the information as it changes. It's not always buy. Sometimes you have to hedge your bets. Sometimes you are looking at other instruments. Sometimes you are diversifying, and the people become complacent, and I'm going to show you how today, right now, this is the most complacent investors have ever been in history. So let's get into it right away. I wanted to start by taking a look at this. Investors plowed more into global stock funds in the days after Pfizer unveiled its supposed breakthrough more than in any other week in at least 2 decades. That is huge. I'll show you the chart that's associated with it, but look at this. Funds that buy stocks counted $44 billion of inflows in the week to Wednesday, including more than $32 billion that was invested in U.S. stock funds, and that's according to the EPFR. And I've noted the EPFR many times before because this is the company that's tracking where the money is moving in and out of, and this is so critical to understand. And people, they just look at what's the hottest trend, and they don't understand the data, because the data is going to tell you exactly where the money is moving to and from, and that gives you the idea and empowers you to decide what you should do with your money. If you want to follow that trend, or you want to be contrarian, or you are looking at this basically from the macro level, and that's totally your decision. It was the largest weekly haul by equity funds since the EPFR has been collecting the data, as well as the second biggest intake by US stock funds since the year 2000. It's just showing you here that ultimately what they have is a bunch of money coming in from institutional investors such as pensions and endowments, and the retail investors, which all the retail investors are so confident at all times, they made just a small portion of that. 3.3 billion versus 41 billion. And right now, retail participation is at the highest we've ever seen. And that's just a fraction of the institutional investors. So people should be paying closer attention to the big people, not necessarily the big investors to copy what they do, but look at where the money is moving to and from. Here's the chart that corresponds to that. You could see the global stock funds tally largest inflows in at least 20 years. This goes back from January of 2020. And if I show you this one, it just gives it to you all the way from 2008. And it is significant when you look at how much money can move in and out of the markets in such a short period of time. And that, of course, might make its way into tech stocks, or it might make its way into some other sector, and we watch that and you look at that and you see how that affects the markets as a whole. And that brings me to this. It's talking about the Federal Reserve and the Fed put. And I wanted to highlight this right here because it shows us that what's been happening in the markets is directly correlated to the actions of the central bank, particularly the Federal Reserve. I won't have time to get into the actual full article, but this is the one I highly recommend checking out that came from Barron's. Just let me get into it really quickly here. Yes, the Fed put really does exist. That could be bad news for bulls. A new study shows conclusively that the so-called Fed put really exists, but that doesn't mean stock market bulls could stop worrying about a bear market. I'm referring to the Federal Reserve's supposed commitment to ease monetary policy whenever the stock market suffers significant losses. You know about this. You heard the Powell put, you've heard of the Greenspan put, the Bernanke put. All of these will be, brought up in the media, and it has been going on, as they say here, since early 2000, when the mentions of a Fed put began to regularly appear in the financial press. It has never been articulated as official Fed policy. However, some have doubted that it even exists. But we know, you and I know, that this is a reality, because as soon as the markets start to dip, that's what it talks about here. As soon as the markets start to dip, they come in. Remember that the Federal Reserve, according to what they say, their two main mandates are price stability and full employment, maximum employment. And this is not something they're supposed to be looking at, but yet it is very clear. It's obvious. The market starts coming down. The Federal Reserve comes in with at least forward guidance talking about what they will do, or a new action. They are going to have to step up their game, that's for sure, in 2021. The actions of the Federal Reserve and all the other central banks have led to basically the same activity all around the world. People are taking on more debt, businesses are taking on more debt, and this is becoming a really big problem. And let me highlight it here in this article. Low interest rates have helped fuel a boom in the housing market in the US. Last quarter, Americans' mortgage debt climbed to a record high of nearly $10 trillion. That's according to the Federal Reserve. And you can see how significant this has been, and there's no possible way that everybody will be able to pay this back. In addition to this, I've got some data that I had shown previously that essentially we have actually pulled more money out of the houses, and we have accumulated more debt as a result. There's more debt out there, less equity, and that is a problem. It's going on all over the place. You can show the statistics in different ways that manipulate and mold this and however they want it, but ultimately this is a very bad thing, especially if people are unable to pay that debt back, which looks like a larger and larger percentage, a growing percentage of people are going in that direction. This article here out of the New York Times is talking about SoftBank and how the founder of it is basically saying that in the short run right now today, because of the crisis that's been brewing, he is pessimistic, and as a result, keeping more cash. Quote, cash is very important in this kind of crisis, and they are essentially worried about what the future has in store. Too much complacency and not enough sound investment taking place. Now, this individual here has been wrong on a lot of things like WeWork, for instance, but it's still worth noting because he's not the only one. This rise in the stock market has created wealth for the mega millionaires and billionaires. And in the case of Elon Musk, his wealth soared $12 billion on Tesla Index Edition. So simply by including this stock inside the S&P 500, he was actually poised to become the world's third richest person, if you can believe this or not. So his wealth, putting his fortune up to, let's say right here, $114 billion. And in this year alone, increasing his wealth by $90 billion. That is absolutely insane to see how much wealth is put into such a narrowing band of assets or investments. And even Elon Musk has said the stock price is too high, and this was a while ago. So it has gone up, so significantly since then, and it just shows you how wild and crazy the markets can be. The Russell 3000 PE ratio is at a record high right now. You can look at many different PE ratios or any different number of indicators, and they are at record highs, and I'll show you some of those today. Market sentiment, according to Citigroup, they show you the panic and euphoria model, and they really are just off the charts right now as they see it. And this is just one more indicator to add to the list. At this time today, essentially nobody is shorting the market. Short interest percentage of market cap S&P 500 median is at 1.7%. Now, generally, you don't find that many shorts, but you can see the direction. It's going down further and further and further. And why? Because of the Federal Reserve and their activities. Somebody had asked me about this, so I definitely wanted to include it here. What's going on with insider trading today? This shows you the insider transactions ratio, and you can see that it has gone what they determine here, this is Reuters, as bearish. So it's moving up. If you look at this, it shows you ratio of insider sales to buys. Readings under 12 to 1 are bullish. Those over 20 to 1 are bearish. And that is really going off the charts today. November survey shows that the fund manager survey investor optimism on stocks has skyrocketed. It doesn't surprise me. I know it doesn't surprise you either. I've got a few from the fund manager survey to show you. Let's take a look at this. What asset class do you think will outperform in 2021? Right now today, emerging markets is really on top of this list. S&P 500 is in second. The most crowded trade, again, month after month after month, is long tech stocks. Tech stocks are, of course, seeing so much of that infusion of cash, of debt, of margin that's been going on, and it seems to not stop anytime soon. What do you consider the biggest tail risk? Right now, of course, the crisis of 2020 has actually accelerated despite this recent information that's come out from Pfizer and the other one, whatever it is. Looking at the next one in line, that is the tech bubble, which has actually increased from last month to this month. And now we have the addition of civil unrest because of the craziness that's been going on around, and people are probably going to get a lot more upset in the near future. The FMS growth expectations are at 20-year highs. The net percentage expecting a stronger economy. Now, the question I have is, why is this number at a record high? Is it because the markets and the economy and the sentiment was down so badly earlier this year, so in relative perspective it looks really good? Or do they actually think that the economy is going to be stronger, much stronger, in the coming months, in the coming year? I'm not really sure about that, but this is very questionable. Same thing for profits. Profit expectations at the highest level since February of 2002. Absolutely ridiculous. Yield curve expectations are at an all-time high. This is going back worse than Lehman, worse than the taper tantrum, worse than all of these other events going back from the financial crisis up until today. The net percentage expecting a steeper yield curve. The Federal Reserve will have to come in and quote-unquote manage that. Fund manager survey cash levels fell to 4.1% from 4.4%. I highlight this specifically because we hear about quote-unquote cash on the sidelines. But of course, come on, 4.1%. And where were they at the peak? You might not be able to see this here, but the peak, which was earlier in 2020, was something like 6%. 6%. You're talking about cash on the sidelines? I mean, I know that a few percent does make a big difference when we're talking about a lot of money like this, but it's not what they tell you, and it's all about reading between the lines. At the bottom of this, you can see from Real Investment Advice, the Smart Money Index versus the S&P 500. And the last time I brought this up, I had a few questions asking me, why don't you tell me what the Smart Money Index is? Why are you not telling me what it is? You never talk about it. You never show me anything. You never document anything. You never source anything. I've done previous videos about it before, but I will highlight it once again. Bloomberg Smart Money Flow Index is a measure of how how smart money is positioning itself in the S&P 500. The logic behind the index is that smart investors tend to trade near the end of the day, while more emotional-based traders dominate the activity in the first 30 minutes of the trading day. And essentially what I wanted to highlight here is you can see the S&P 500 represented by that orange line, which has basically moved in an upward direction, as you know, but the smart money has been doing quite the opposite. Now, I want to see, because the institutional investors just poured in all that cash into equities, I want to see if that changes right now. If I can get more recent data, when I do, I will definitely bring it to you. But up until this point, it's been heading downward. So I'm interested to see an update on this, that's for sure. Market greed fear gauge. I've shown you this before. It is a very good indicator of what's been happening. And today, the extreme greed is just off the charts. There's no denying that. This is one good indicator, again, from Real Investment Advice, that is better than many of the others to give us an idea of where we are headed and where we are now. Sentiment Trader had this one here. It's just showing you yet another ratio that essentially breaks it down, looking at it, the highest ever. And, you know, there are so many of these things. The interesting point about this is that when we get to these levels, that it oftentimes ends very badly as a result. In the short term, look, you might have a pullback of 10%, of 20%, of 30%, of 50%, whatever it might be. It could be simply a few percent. But when we get to the levels like this, it tends to turn around for the stock market. And then we have this technical overbought sold composite, yet another indicator showing us that we are at a record high. This goes back to 1998, going way, way off the charts in so many ways. And it's unbelievable. I mean, we've been at this point a few times before, but give or take, come on, we are at the record and there's no stopping this. And I just wanted to note that you don't have to worry, because my favorite, Janet Yellen, is tight-lipped on report that she's in the mix as the Treasury Secretary. She will take care of it all, have no fear, because under her watch, there will never be another financial crisis. That's all for this video. If you found it informative, hit that thumbs up button by clicking one button. You support me, thank you. If you want to learn about e-commerce, if you want to understand how to sell stuff online, check out my free e-course, theamazongps.com. If you want to know about the financial system, you want the two easiest but yet well-documented books, you got to check out these two at the link in the description. If you want the audiobook instead, themoneygps.com. Did you watch this video yet? If not, definitely do. Click on it and I'll see you there.